Good day, class. This is the final section of topic 2. And we continue with chapter 6, which is on valuations. Now, we've already used the time value of money principles and tools that we started off with to value bonds and learn a little bit more about bonds or debentures. And now we need to do the same with shares, as well as valuing the firm at a company as a whole. So I'm going to share my screen for the slides. I hope that you can all see that. And I'll start my slideshow. There we go. Okay, so as I said, it's a continuation of chapter 6 from where we left off. We've already tackled the bits in blue. We spoke a bit about valuations in general, the risk-return relationship, and we valued debentures or bonds. Moving on now, we're going to be learning how to value preference shares and ordinary shares, as well as the firm as a whole. And we're also going to talk a little bit about characteristics of preference shares and a little bit of more information about shares in general as well. Okay, so starting off with preference shares. These are a class of share that firms issue when they want to raise funding, and they're different from ordinary shares in that preference shares shareholders receive a fixed dividend. As we know, debenture holders or bond holders receive fixed interest. So it's quite similar in that regard. Preference shareholders receive a fixed dividend. Now, these dividends are paid only after all expenses have been incurred, including interest, which means that preference share dividends are more risky, and therefore preference shares need to offer a higher return to compensate investors for that risk. The fixed dividend will be expressed as either a rand amount or as a percentage of its par value. Therefore, unlike ordinary shares, a preference share's par value actually has significance. Sorry, I'm just trying to find my highlighter pen. There we go. If the firm fails to pay a preference share dividend, then that dividend is said to be in arrears or it's been passed. And in that case, those arrears will have to be paid to preference shareholders before ordinary shareholders can receive any form of dividend. And preference shares which possess this particular characteristic are called cumulative preference shares. Okay, they're cumulative because all the dividends in arrears, as well as the current dividend, have to be paid to preference shareholders before any dividends can be paid to ordinary shareholders. And most preference shares are cumulative. So it's the more common case. Non-cumulative preference shares, on the other hand, are those when the unpaid dividends don't accumulate. So they won't be paid, and only the current dividend has to be paid before any dividends can be paid to ordinary shareholders. Okay. So the different types of preference shares, cumulative, I've already spoken about, and conversely non-cumulative. Then you get redeemable preference shares. These are when, preference shares, the dividend is perpetual, it's like a perpetuity, but the shares might have a call feature, just like with bonds, which give the issuing firm the option to retire that those preference shares if the need or the advantage arises. So similar to a bond feature or to bonds with a call feature, which allows the firm to redeem those bonds before they mature. So too can preference shares be redeemable. They can also be participating preference shares, which allows preference shareholders to participate along with ordinary shareholders in the receipt of dividends beyond a specified amount. Or, for example, they could participate in the firm's profits as well as their dividends. So they participate in the profit share as well as getting their fixed dividend. They can also be convertible preference shares, which means they can be converted to ordinary shares according to a pre-specified exchange formula. In other words, for every preference share that you have at a certain time, if you want to, you can convert that into 2 ordinary shares or 1 ordinary share, whatever the case may be. That'll be stipulated when those preference shares are issued in the first place. We often refer to preference shares as hybrid securities because they possess the characteristics of both ordinary shares and bonds. They're like ordinary shares because they're perpetual securities with no maturity date. But they're like bonds because they are fixed income securities. They get a fixed dividend that never changes. So they're quite simple to value because we know how to value a perpetuity. When the cash flow, the future cash flow to infinity they're all the same, they're identical. In other words, they form a perpetuity. We can just use our present value formula, which says that the price of a pref share at time period 0 is equal to the fixed dividend that never changes divided by the cost of equity. For example, the preference dividend of Denham Company, an established textile manufacturer, is 30 Rand per share per annum. What is the value of this share if the required return demanded by investors is 15%? In other words, our K is 15%, our D is 30 Rand, and we just divide the two to get to the price of, or the value of, this particular preference share. It's 200 Rand. That's what it's worth. So what happens when we have cumulative preference shares that are where the dividend's now in arrears? For example, we've got 100 preference shares with an issue price of 1 Rand each, so that's their par value. The preference dividend rate is 12%, which means that every year investors will be getting 12% of the 1 Rand issue price, which is 12 cents. And similar shares are offering yields of 14%. Okay, so that fixed dividend, here's my pen, is 12% of 1 Rand, which is equal to 12 cents. Okay, just say they're going to pass that dividend. In other words, in the next 2 years, this company will not pay the dividend. Then the value will have to be determined in 2 parts, because we now have a timeline where the first 2 years have 0 cash flows, and then the 12 cent per share dividend will start getting paid again to infinity. So we're going to value the perpetuity as and when it starts, okay? And we'll do that at the end of year 3, okay? And we'll put the 12 Rand, it's 12 cents, not 12 Rand. sorry, my mistake. This has to be 12 cents. So it's 0.12. Forgive me, I'll make a change. Over the 14%. And let me just double check that the answer is in fact right. No, it's 85 cents. Okay, you know what's going to be easier? If I say, sorry, because there are 100 preference shares. Forgive me. They have 100 preference shares with an issue price of R1 each. So those 100 preference shares will get a dividend of 12 cents times 100, which is equal to 12 Rand. Sorry. I'm confusing myself here. It's because there are 100 of them. Okay. So let's ignore. Where's my eraser? I can't find it. But anyway, this is in fact correct. Okay, 12 Rand divided by 14%. We use the market required rate of return of 14% as our K. And as at the end of year 3, this preference, these 100 preference shares will be worth 85 Rand 71. And also at the end of year 3 is when they start paying dividends. So there will be paid the year 3 dividend plus the 2 that were passed or missed, the year 1 and the year 2 dividend, year 2's dividend. So also as at year 3, we have 36 Rand that's going to be received in terms of dividends. Okay, so if we've got a timeline, and you know I love my timelines, 2, 3, 3, 2, 1, 0. Okay, so year 1 is passed, no dividend. Year 2 is passed, no dividend. Year 3, they'll get the year 3 dividend of 12 Rand plus these 2 that were passed before, and they'll have accumulated. So they'll get 36. And then every dividend from year 4 onwards is also going to be 12 Rand. So we present value that perpetuity as at year 3 by putting year 4's or the perpetual dividend from that point over 14%. And that is where we get this 85.71. Excuse the strange art. Okay, so from a cash flow perspective, end of year 3, 36 Rand of dividends will be due to this person that owns 100 preference shares, plus 85.71. That's the present value of all the dividends from the 4th one onwards. So we'll add those two, and that gives us 121.71. Okay, and now we're going to put these cash flows into our financial calculator. 14 is our IYR, 3 is our N, because we are present valuing these back 3 years. 36 plus 85 Rand 71 is the future value as at year 3, 121.71. And we want to discount that amount back 3 years at 14%. So we get our PV as at year 0 is 82 Rand 15. Okay, so in this situation, the value of those 100 preference shares is 82 Rand and 15 cents. Good. Now, what if the preference shares in the same example were non-cumulative? Okay, remember I told you this is where any dividends that are passed will not accumulate, and they'll just get paid the dividend, the next dividend that they're that they're due to get. So those 2 past dividends will not be received at all, and the value of the share will simply just be that of a perpetuity that's starting in year 3, because from year 3 onwards, they'll get the 12 Rand per annum for those 100 preference shares in terms of dividends. So what's important to note is we'll be valuing this perpetuity as a time period 2, because this perpetuity starts in year 3 with 12 Rand. And whenever we present value, we always take the next dividend, the next cash flow, which is 12, and put that over the required rate of return of 14%, and that'll give us the present value here. Remember, when we're at time period 0 and we're present valuing a perpetuity that starts immediately, the value at time period 0 is that first dividend over 0.14. So now when we're further down our timeline, the value at time period 2 of this perpetuity will be the third year's dividend, which is going to start in year 3 of 12 over the 14%. Okay, and then this 8571 is sitting here. Sorry. And we have to present value it back 2 years at 14%. So this becomes our future value, this 8571. You can either just divide it by 1 plus the 14% squared, or you can use your financial calculator, put the 85.71 in as your future value, 14 is your RYR, 2 is your N, and ask for PV. Okay. At the value of this preference share, these preference shares, if they were non-cumulative, would be 65.95 Rand. Okay. So it's really just, we're still present valuing the future cash flows of a security in order to value it under 2 different circumstances here. Okay. Why would a firm pass on the dividends? Quite simply, there are times when they've got insufficient cash resources to pay out a dividend. They might be going through a growth phase and they really need to reinvest their retained earnings into the company and not pay dividends for a couple of years until they're in a position again to resume the dividends. So then it's necessary to estimate when the firm is going to be starting to pay a dividend again, and then that's where your timeline becomes so important. And then you have to value the shares accordingly, as at when those dividends actually are going to be paid, whether the cumulative ones that were passed plus the current one and all the ones into the future, or in the case of a non-cumulative preference share, it will just be the present value of the perpetuity whenever it does start. Okay, but your timeline is important to see when, at which point you are valuing the perpetual phase of the dividends, and then you've still got to present value that back to times 0. Okay. So that's preference shares. Let's move on to ordinary shares, which are far more common. Preference shares aren't often issued by companies. Ordinary shareholders are sometimes referred to as the residual owners or the residual claimants, and they're the true owners of a firm. As residual owners, they receive what is left, hence the word the residual, after all other claims on the firm's income and assets have been satisfied. In other words, they've paid all their expenses, They've paid their taxes, they've paid interest on their loans or their bonds, or coupons on their bonds, they've paid the preference share dividends. Then if anything's left within the dividend policy of the firm, that is what the residual owners or ordinary shareholders would receive. Because they sort of back ranked to such an extent and they sort of last in the pecking order, ordinary shareholders expect to be compensated with adequate dividends and ultimately capital gains, which means growth in the value of their investment. But they also then would want, for the reason that they're taking a higher risk. They're only going to get paid any dividends once everybody else has taken their piece of the pie, as it were. Unlike bonds, ordinary shares may be issued without a par value. The par value, if they do have one, it's generally low, and it's a relatively useless value that's established in the firm's corporate charter. So the payment of dividends is completely at the discretion of the board of directors. Most companies will try to pay a dividend once or twice a year, but as I said before, sometimes they're not in a cash position to do so. Sometimes they're in a growth phase. They need to retain all their earnings instead of pay them out in terms of dividends. Most dividends are made in terms of cash. They might be made in terms of shares, and sometimes even merchandise. I remember a long time ago, KWV, what did they make? Well, it's a winery company. They paid their dividend in terms of bottles of wine, but that's not particularly common. Okay, we've already discussed the fact that shareholders are residual claimants, so they only get any dividend payments after government creditors, preference shareholders have been given their due. The dividends received by individuals from South African companies are generally exempt from income tax. So you as a shareholder won't have to pay tax on your dividends directly to SARS, but in fact what's happening is, in terms of the withholding tax, the firm that pays the dividends has to hold back 20% of the dividend that they in turn then pay over to SARS. So you're getting less dividends as a consequence. So you are the person actually paying the tax. Okay, so DWT is your dividend withholding tax, and that's how it works. The recipient of the dividends doesn't pay it directly, any tax directly on the receipt of those dividends, but the company who issued them or paid them does on their behalf, as it were, and it comes off the amount that they pay out as the dividend. A firm can't go bankrupt if they don't declare and pay a dividend. So it's not like if you have a loan and you default on that loan, where you can eventually go bankrupt. So it's not the same as debt. It's something that your shareholders would hope to receive, but they're not guaranteed to get a dividend. And it's not something that's going to land the company in trouble if they have to pass the odd dividend. For some investors, obviously, their dividends are very important to them. They might rely on those dividends for their monthly revenue, or their, to survive. Pensioners in particular might have investments in firms that typically do pay a dividend because they need those dividends to live off. I just want to share with you a bit where, you can find share price quotations in the business press. You can find them online on various sites. So you as an investor in shares, you can on a daily basis or at any point of the day, you can go online or you can look in the Business Day newspaper and you can see what your shares are worth on that particular day. And financial managers as well also want to monitor the share prices of their company. They want to see how the market is viewing the performance of the company, what their future prospects are, etc. And as I said, this price information is available from brokers. It's available in various news media as well, print and on the internet. And you'll usually see it, if you don't specify, if you don't enter that you want to track a specific company share, you can also see it based, all the shares that are listed under a specific industry, like under chemicals, which is a subcategory. You've got shares like AECI, Afrox, Delta, etc. Basic resources, you've got Mondi, you've got SAPI, and so on. Industrial metals and mining, and so on. I'm just going to show you a typical share quote. I got this a couple of days ago off the internet. I got it from www.sharedata.coza. I specifically looked up Aspen, or APN as it's shortened to in the financial press. So it was as of the 30th of March. And it showed me what Aspen shares last traded at. So at the close, the latest, so as at 2:12 p.m., the latest trade was at 199 Rand and 9 cents, which was down from yesterday's close, which was 200 Rand. And it was down by 91 cents or 0.46%. You can see the best bid that had been made and the best offer that had been made and the volumes, the corresponding volumes, the number of shares at those prices that had been made so far on this day. Trades totaling 2,107 transactions. So 2,107 transactions have taken place, the buying and selling of Aspen shares on this day so far. The volume of shares, 338,859, have changed hands on this day. And the value of that volume, so that number of shares times the price at which they were bought or sold, is 67.6 million. So the day opened on 202 Rand and 30 cents. It was the first trade of today. So far, the highest trade of the day was at 202 odd Rand, and the lowest was 196. Okay, so you can get all sorts of real-time data on any particular share that's listed on the JSE. Also on this page that I looked up, I could also see details of the last 20 trades that had taken place. Also the dividend yield for Aspen, its earnings per share, its price earnings multiples, ratios, and also comparative data of similar firms in the same pharmaceutical industry. So you get a wealth of information about a particular share. And as I said before, that's useful for both people wanting to buy or sell Aspen shares. It's also very useful for Aspen management to track what's happening with their share on a daily basis or on an hourly basis, minute basis. This information is only 15 minutes delayed from real time, which is amazing. Okay, and then you can make decisions based on this information. Should you buy? Should you sell? Because Because remember, these share prices, these market share prices that you see, they contain all the information that investors and companies have at their disposal, and they act upon that information, and these market prices are the result of that, that trading. Okay, so shareholders want to be compensated for their investment in two ways. Yes, they'd like periodic dividends, and for some types of investors, as I said before, dividends are more important than others. But they also want to make a capital gain. In other words, they want the value of their investment to grow. Investors will typically purchase shares when they think they're undervalued, and they'll sell them when they think they're overvalued. They base their investment decisions on their perceptions of the risk involved with investing in that particular share. And in competitive markets, like on the JSE, the interaction of all the buyers and sellers will result in an equilibrium price, which is the market value for each of those securities. And as I said, that price is reflective of all the information that's available to the market participants in making their buy or sell investment decisions at any particular time. And this is a very good time to talk to you a little bit about the efficient market hypothesis. I think that Dr. Mkadi spoke about it in topic 1, or referred maybe to EMH in topic 1, but we need to consider it in a little bit more detail here. Still not too much detail though. More will come later when you're looking at risk and return and portfolio management later on in your finance studies. So we spoke a bit about a gentleman called Warren Buffett, you remember, who's a very well-known American, a very successful investor in world stock markets. And we've heard stories about people like him making an absolute fortune on the stock market. But there are also a lot of stories about those who've lost all their money in the same market. And you have to wonder, is it a matter of luck, or are they just particularly skilled? And throughout your finance education, you'll see that there are people siding on both sides of that argument. It's very helpful if you can grasp the basics of this theory, sufficient market hypothesis theory, as an important foundation to your studies. And when we're asking about whether a market is efficient or not, we're really asking if share prices or bond prices, any asset prices, show all relevant information or not. So the theory is all about how accurate market prices are. And the efficient market hypothesis specifically posits that a company's share price does reflect all available information. If you want to buy something, you buy it. If you don't want it, you don't buy it. Or if you already own it, you'll sell it. But is it that straightforward? What if you think that prices are going to go up in the future? What if you think they're going to go down in the future? There's uncertainty about this. You can't know this with any great certainty. And what else might be hidden in the price? If you take the example of when you buy a car, a secondhand car, how do you know that it hasn't been in some sort of major crash, or if the engine is on its way out, if you don't have all the information? And is there a way for you to get all the relevant information? And it very much depends on all the parties being honest and transparent. So it's a very critical concept in finance, this idea of true or intrinsic value of an asset. And unfortunately, it might not always be the same thing as its book value. And book values and market values are generally very different things. the book value, for example, of assets as represented in fixed assets, non-current assets as represented in the financial statements, for example, are reflected at cost minus accumulative depreciation, which might have absolutely no bearing on its market value, which is what you would get if you put that asset up for sale at that particular point in time. But and the true or intrinsic value is what we're trying to arrive at when we're doing all these valuations. So I'm teaching you all these techniques. Now, intrinsic, book, and market value should all be the same if everybody had the correct information. But in reality, there are reasons why that might not be the case. In a perfectly efficient market, prices would always reflect their true value, and those prices would change instantly, not on a delayed basis, instantly, if new information relevant to the price became known. The more competitors we have in these financial markets who are actively trying to find any undervalued or overvalued assets, the quicker prices will then reflect their true value. So you've got all these investors trying to beat the market, thinking that they know something that other people don't, and that they know whether share X is over or undervalued, and then they buy or sell that share X. And, you know, the more of them are doing that, the more efficient it makes the market, and the quicker prices will reflect their true value. So market efficiency is the thing that I'm trying to get across to you at the moment. You know, are financial markets like the JSE perfectly efficient? Can we trust those prices as being the true value of those assets? Now, the EMH actually describes three forms of market efficiency. So, you know, if you say a market is efficient, you know, there are different degrees of efficiency, if you will. There's strong form efficiency. Well, let's start at the bottom with weak form efficiency, rather, this third form of market efficiency. At its weakest, all historical information about an asset will be included in its price. So you can't identify abnormal profit opportunities if you use what's called technical analysis. In other words, you use past price information about a share to determine, you know, whether the share is worthwhile or not. So in its weakest form, historical information about the asset is included in the price. If the market's semi-strong form, then all relevant publicly available information, including historical information, is included in the price. So here, in markets that are semi-strong form efficient, it's very difficult to make abnormal profits without having insider information. Now, insider information is information that a single person or a group of people are privy to, and nobody else is. And using inside information is actually illegal in most countries, certainly here. So you're not supposed to be able to use inside information to try and make abnormal profits. But certainly in a semi-strong form efficient market, the only way in which you could make abnormal profits consistently is if you had inside information, because all publicly available information and historical information is already included in the share prices. So neither technical analysis, which is where you investigate or research past price information, nor what we call fundamental analysis, which is where you analyze the firm's latest financial statements and performance, etc., and try and use that to beat the market. That would not be of any use to you in a semi-strong form efficient market, because everybody's got that information already. They've already acted on it, and the prices reflect that. In its strongest form, and there's not too much evidence in the world of strong form efficient markets, this is where all information, even inside information, is included in the price. So in a strong form efficient market, it would be impossible to earn consistent abnormal profits, because no price is valued, no asset is under or overvalued. The price is correct. And if changes arise in the market, those changes will reflect immediately, without time for anybody to take advantage of that change. Okay, I just wanted to show you that what happened there? Trying to draw a picture. These three forms don't sit next to each other. They're concentric. So here's your weak form efficient market. Here's your semi-strong. And here's your strong. So in a strong form efficient market, not only can't you use past information or past price information or publicly available information, but you also can't use inside information about companies to be able to identify or make abnormal profits in a market, in such a market. Okay, so they sort of build on each other. If I was to illustrate these three forms with concentric circles. Okay, so you're sitting here saying, well, what's the point then? If a market such as the JSE is relatively efficient, how do you make an abnormal profit? How do you make a profit if the price that you're paying is exactly right for a particular asset, or the price you're receiving when you're selling an asset is exactly right? We're not saying that you can never make abnormal profits. You just can't consistently do so when the markets are efficient. Okay, there's a subtle difference. There's also nothing to stop you from investing in good, solid shares on the stock market or bonds, whatever the case may be, and then holding them for the long term. Okay. If the companies that you've chosen to invest in were wise choices and they've continued to show solid performance over time, you will get that capital gain in that investment. But it's just when you're trying to make a quick buck in the markets, go in and out of shares in the short term, that's what becomes difficult the more efficient the market is. That's what we're trying to say. Okay, so just remember the EMH. It's an important sort of foundational theory for a lot of what's still to come in finance. Not necessarily in second year, but certainly going into third year and honors if you are to continue with it. Because, we're going to start talking about portfolio management in finance, and this is where the theory that underpins the markets is going to come to the fore. All right. Okay, there are lots of ways to value a firm's equity. What's ordinary equity? And we're going to visit a few of them. So you've got your dividend discount model, or DDM. That's where, just like we did with bonds, we're going to discount the future dividends of a firm. And we're going to look at three scenarios. The case where the dividends don't grow at all, that's zero growth. The case where they grow at a constant rate over time, that's constant growth. And then variable growth, where it's not a constant growth rate in dividends that we are contending with. We'll learn how to value ordinary shares in each of those instances. We can also use price multiples. We can use PE multiples, price earnings, market to book multiples, and EBITDA, earnings before interest, taxes, depreciation, and amortization multiples. This is where we compare similar firms in the industry, in the same industry, and we use those multiples to value our particular firm that we're trying to value, or the shares that we're trying to value. We can also use the free cash flow model. This is another income approach over and above the dividend discount model, where we discount the future free cash flows to the firm at the firm's cost of capital, and then we deduct the value of its debt, and we're left with the value of its equity. So we use the free cash flow model to value the firm as a whole. Then we take off the market value of its debt, and we're left with the market value of its equity. Then we can divide it by the number of shares, and there we have a share price. We can also use EVA, economic value added. I think you've already learned a little bit about that in topic 1. This is where we discount a firm's future EVAs at the firm's cost of capital. The most important are the dividend discount model and free cash flow models. Okay. Just to recap, as with bonds, the price of the share is the present value of its future cash flows. In the case of bonds, those future cash flows were those coupons and that face value that you got at maturity. In the case of shares, we've got dividends. But we don't always know what the dividends are in advance. We also don't necessarily know the timing of those dividends in advance. The life of the investment, unlike with bonds, where we had a fixed maturity date, is essentially infinity. Shares don't have a maturity date. And there's also no easy way to observe the rate of return that the market requires. Some companies, as we saw just now, don't pay dividends, especially if they're in a growth phase and they want to reinvest all their funds in capital projects. That doesn't mean that those shares don't have a value. At some point, they are going to start paying dividends again. Dividend policies themselves change as a company goes through different life cycles. So, it's only once a company is fairly mature in the market that they might consider having a constant growth rate in their dividends as part of their dividend policy, as an example. Now, despite the difficulties I've just mentioned, there are cases under which we can establish the present value of future dividends. And we can therefore determine its value. We have to make some assumptions, though, about the pattern of those future dividends. Assumption number 1 is where we have zero growth in the dividends. Okay, so the firm's policy is we're going to pay this particular dividend always. Now, that's exactly the same as what we looked at. Well, that's how preference shares work anyway. The firm maintains the same dividend going into the future. So we're essentially valuing a perpetuity here, where D0, the dividend just paid, is equal to D1, which is the first year's dividend, is equal to D2, which is the second year's dividend, and so on to infinity. So we put that dividend over the cost of equity to value such a share. So if the dividend is going to be 80 cents and it's never going to change, and the cost of equity is 11%, then the value of that particular share the intrinsic value will be R7.27. Okay, so that's assumption number one. Assumption number two is that the firm's going to have constant growth in its dividends. In other words, it's going to pay dividends that are going to grow at the same rate forever. And here's where we use the dividend growth model. It's also known sometimes as Gordon's growth model. Its value, share value, is the present value of its future dividends. The dividends are growing at a constant rate. It's similar to earlier in chapter 2 when we introduced the formula for a growing perpetuity. Do you remember that one? Where PV, present value, will equal the next cash flow, the next dividend. So it's the current one, the one that's just been paid, D0, grown by this constant growth rate, G. So you multiply it by 1 plus G, and that gives you D1. And you divide that by K minus G. So D times, there's a naught that's implied here. D0 times 1 plus G is next year's dividend. It's D1. Get used to calling them D1, D2, D3, D0, or whatever they are. K is your cost of equity. G is that future constant growth rate in dividends that's not going to change. So P0 is equal to D1 over K minus G. If the constant growth doesn't start immediately, we've got a more general formula which says that PT, so the price of a share at time period T, is equal to DT plus 1, which is the next dividend after T. So it's the Tth plus 1th dividend divided by K minus G. And you'll see where this more general formula is going to come in handy when we're valuing, well, when we're assuming variable growth in the dividends. The assumption of a constant dividend growth rate might not be particularly realistic, but it's most relevant, as I mentioned just now, when we're valuing a firm's shares, which is in a very mature industry sector. They've got very steady growth prospects. Nothing spectacularly good or bad. It's just a steady growth in earnings, which will translate into a steady growth in dividends. So it is a policy that some firms will have, one of constant growth rate of your dividends. How do we estimate G, that growth in dividend? The answer is with difficulty, or how does a firm arrive at G? Dividends are obviously a policy, a function of the firm's dividend policy, and that in turn is going to be a reflection of what's going on in the economy with that particular business at the time. So it's not so easy, but surrogates can be used. For example, what do they think their earnings are going to grow by in the future? What will their cash flows grow by? There's something called that you'll learn about in chapter 5 called the sustainable growth rate. In other words, it's a rate, it's the rate at which the firm can grow given a certain debt to equity ratio that they want to maintain and given a dividend payout ratio. That can normally also help as a base for that formulation of G. But, don't worry about that at this point. Your growth in dividends over the long term should reflect earnings growth. If your earnings per share, for example, is growing at 10% per year, and the current dividend growth is 20%, then that's not sustainable over the long term. So earnings growth is a sort of an anchor for dividend growth. So if your earnings are going to be growing at 10% per year, you should not be paying more than a 10% well, you shouldn't be paying dividends at more than a 10% growth rate every year. Okay. Here's an example. This firm paid the following year in dividends from in the last 1, 2, 3, 4, 5, 6 years, from 2016 through to the latest one. And the dividends they paid in each of those years have been provided here. So at what rate did these dividends grow? If you worked it out year by year, the year-on-year increase, you'd see that it was sort of 6.9% from 2016 to 2017. Then it was 7.02%. Then it was 6.99%. Then it was 7.03%, and then it was 7.02%. So it's averaging out at around 7% for this particular firm. You can use your financial calculator, actually, to work this out. I'm going to stop sharing and let's go and look at our financial calculator. Clearing my screen. I see a 1 PYR, which is great. And all you have to do is put in the first dividend as your PV. So I'm going to go 10 minus as my PV. I'm putting the last dividend in as my FV, 14.02 as my FV. It's a 5-year period, so 5 is my N. And I want to know the IRR. In other words, what was the average return, well, the average increase over this 5-year time period of an amount that started off being 10 Rand and it's now 14.02. I'm just solving for the IRR. It's pretty much 7%, 6.99%. Okay. I'm going to stop sharing again and go back to our slides. So we've worked out approximately a 7% growth in dividends year on year over that 5-year period. So let's say the required return is 15%. And we've calculated the historical growth in dividends is 7. So if they continue in the same vein, the next dividend, D1, so the 2022 dividend, in other words, will be 7% higher than the one that was paid most recently in 2021, which gives us a D1 value of 15 Rand. And now if we assume that there's going to be a 7% increase in dividends going forward, then P0 will equal D1, which is 15 Rand, over R minus G, 15% minus 7%, 187 Rand 50. So that's assuming the values of D1, K, and G are all accurately estimated. These shares have an intrinsic value of 187 Rand 50, taking into account all the future dividends that are hopefully going to grow at 7% and at a required return of 15% on this particular investment. We can also use the dividend growth model to solve for the cost of equity, or our IRR. Share returns are derived from both dividends and capital gains. I've already said that, where your capital gain results from the appreciation of the share's market price due to a growth in the firm's earnings. Mathematically, if we rearrange the dividend growth model, the expected return on equity would be D over P, which is the price. So the dividend over the price plus the growth rate. For example, if their 1 Rand dividend on a 25 Rand share is expected to grow at 7%, so let's just say that they're going to be paying a dividend of R1 on a share that they paid 25 Rand for then their expected return will be 1, which is the dividend, over 25 plus G is equal to 11%. Okay, so just by rearranging the dividend growth model, we can also solve for K, or the expected return on equity. And if you look closer, I've lost my pen. This return on equity K, this formula is showing us very clearly. Here's the two parts of return that you get. Here's your dividend yield, which is your dividend over your share price. So that's the percentage return you get from the dividends. And this should be your capital gain yield. That should be the amount by which your share price capital gain yield. So you could break that 11% down into two components. D over P is your dividend yield. So that's the return you get from dividends on the share. And G is going to be your capital gain yield, because if your dividends are going to grow at G per annum, so too will your share value grow. Okay. Now, what do we do when we don't have a zero growth in the dividend and we don't have a constant growth rate in our dividend? So what if it's non-constant or variable? Now, your book refers to a two-stage model, but it's actually got 3 stages. So I've just taken the step of renaming it. I'm going to use a 3-stage model. So how do we value a company which is experiencing a high growth in dividends, followed later by a lower but stable growth rate in dividends? So initially, maybe it's a new firm, or they're experiencing a high growth phase, and then once the market reaches maturity, or the firm reaches maturity, they might slow down and settle on a more stable, constant growth rate, but later on in their life. Example, Highfly Limited is expected to experience a growth rate of 30% for the next 3 years. So that's 30% per annum for the next 3 years. So high growth for the next 3 years. And then it's going to settle down to a growth rate of 6% per annum indefinitely. The cost of equity is 12%, and the current dividend, so when you see current dividend, or the one that's just been paid, that's your D0, okay? So D0 is 60 cents a share. Right, so there are 3 steps, as I said. First things first, work out what the dividend's actually going to be for the first 3 years. So D1, so the first year's dividend is going to be the one that's just been paid, which is D0, but 30% higher than it, because it's going to be 30% growth. So D1 will be 78 cents. D2 will be 30% higher than D1, which is 1 rand and 1 cent. Dividend 3 will be 30% higher than that one, which is 1.31. Okay, so we've worked out in the first step what those 3 dividends are going to be in years 1, 2, and 3. So this is the first 3 future dividends. Step 2, let's work out the value of the share at the end of year 3, because beyond that, there's going to be a constant growth rate in dividends. And we know how to value a share when there's constant growth in dividend. So using that formula, the more general formula I showed you a couple of slides back, where PT, so the price of a share at any point in time T, is equal to the next dividend after T divided by R minus G. Here we're going to value the share at time period 3, because the first dividend to incorporate that constant growth rate of 6% is going to be the fourth one. Do you agree? Here, the first three, they just increased one on one by 30% each. But after that, there's going to be a growth rate of 6%. So D4, fourth dividend, will be 6% higher than D3. And when we present value every dividend from the fourth one onwards, where there's a constant growth rate of 6%, we'll be valuing it as at time period 3. So P3 is equal to D4 over K minus G. To get to D4, we've got to multiply D3 by 1 plus 6%. And then we divide that by K minus G. Sorry, got dogs in the background here. Okay, so P3 is equal to 131 times 1.06, which is D4. Can't even tell her to keep quiet because she's deaf. Divided by K minus G, which is 12% minus 6%, 23 Rand and 17. I think I should try it. My apologies, I'm back. I just had to sort out the barking. Okay, back to sharing the screen. Okay, so we were evaluating the constant growth phase of the dividends as at time period 3 by taking D4 and putting that over R minus G, and we get 23 Rand 17. Okay, that's the second step. So we've dealt with the first 3 dividends, which are all different. We've dealt with every dividend from the fourth one onwards, and now we've just got to put it all together in step 3. And this is where our financial calculators will come out. We're going to use our CF keys, CFJ key, and our NPV. So don't forget the first cash flow, it's naught. Don't put D0 there. D0's happened. Okay, naught is CF naught. D1, 0.78 is CF1. D2, 1.01 is CF2. D3 plus P3 have to be added for the third cash flow. Okay, D3, which is the third dividend, plus P3, which is the present value of every dividend from the fourth one onwards. So 24 Rand 48 is the third cash flow. It's the third dividend plus the value, the present value of the fourth dividend onwards, which was a constant growth phase. That's our CF3. Pop in our 12-hour R, and we get the NPV, which is 18 Rand 93. Okay, and just as a check, ask yourself, have I present valued all the future dividends? Yes, I've included D1. I've present valued D2. I've present valued D3. And P3 represents the present value of every dividend from the fourth one onwards, from D4 onwards. So yes, I've included all my dividends. I've present valued all of them at 12%. Therefore, I've done it correctly. Okay. And sometimes, again, it's useful to draw a timeline. Okay, and this has got 0.78. Wish I could write better with this. 1.01, 1.31. And then because your constant growth rate of G starts here. So initially there was a growth rate of 30%, but the one that's constant to infinity was 6%. And the first dividend that we used the 6% to calculate its value was D4. So we put D4 over K minus G and get P3, which represents the present value of every dividend from the fourth one onwards. Okay, and that's why we add these two together to go into our formula as our third cash flow. Okay. What happens when the dividends are distant? Okay, so companies growing at a rapid rate, but they're only going to start paying a dividend sometimes in the distant future. So they need all the cash and all the earnings to be retained to enable them to grow in the next few years. So this company expects to only start making a profit from, my screen is blocking the slide, from year 8. And they're only going to start paying a dividend of 20 cents per share from year 11. Now that's going to double until year 13. And thereafter, it's going to grow at 7.5% per year. So you've got to be very clear in your mind on a timeline what's happening here. From D1 to D10, the dividend will be nothing. Then the 11th dividend will be 20 cents. It's going to double for the 12th dividend. It'll be 40 cents. It's going to double again for the 13th dividend, which will be 80 cents. Thereafter, it says they're going to grow at 7.5% per year. So the 14th dividend will be the 13th dividend plus 7.5%, basically, which is 0.86. So similar to the previous one, it's no different except that some of those initial dividends are 0. And then we've got three different, 3 different dividends. And then from year 14 onwards, we've got constant growth rate in dividends. So we can work out the present value of that constant growth phase of dividends at P13 by putting D14 over K minus G. Why D14? Well, it's the first dividend that incorporates that constant growth rate of 7.5. So if we're putting D14 in here, we must be valuing the share at P13, at time period 13, sorry. Because remember, PT is equal to DT plus 1. So if T plus 1 is 14, then T must be 13. So we get the value of the share as at time 13, which is 13.23. Also at year 13, we've got the cash flow of the 13th dividend of 80%. 80 cents. We mustn't forget that. So what will P0 be? Well, we've got basically 10 cash flows of 0. So I'm putting in CF0 in as 0. I'm putting CF1 in as 0, and there are 10 of them. So that's, remember, we use our NJ key. Perhaps let's call up the calculator to illustrate. Okay, so 0 is our CF0. 0 is our CF1. There are 10 of them. So I'm going to go 10, second function NJ, to tell it that there are 10 of those. Then my other dividend stream starts. The 11th dividend is 0.2, 20 cents. That's CF2. The 12th one is 0.4. That's CF3. The 13th one is 0.8. That's CF4. Sorry, it's, yeah, CF4. My RYR is 14. And crumbs. I left out the next dividend. I wonder if you can put it in retrospect. Let's see. So I've got 80 cents. No, I did it wrong. Let's go back to the beginning. My apologies. Okay, so 0 is my year 0 cash flow. Then I've got 0 again, and there are 10 of them for years 1 to 10. The 11th one is 0.2. The 12th one is 0.4. The 13th one is 0.8, but I've got 0.8 plus P13, sorry, which was 1323, which is equals that, and that's my CF4. Okay, 14 is my IRR, and I want my NPV, second function NPV. R2.69. Okay, so we valued this share at R2.69 by present valuing all its future cash flows. Okay, R2.69. So we put in the first 10, which was 0. We put in year 11's, year 12's, year 13's dividend, plus the present value of every dividend from the 14th onwards, and our 14% IRR, and we got our NPV of R2.69, which is the value of the share today. Okay. Now, the value of shares in companies with distant cash flows, like this one, are very sensitive to changes in dividend expectations and or risk, which affects interest rates. You know, if you're trying to value something today and you're guessing when it's going to start paying a dividend, what the size of that dividend is going to be, what will interest rates be, a lot more uncertainty starts creeping in, like in this one. But you've got to come up with some kind of a benchmark value based on assumptions and estimates. So this is how you do it. Okay, we applied the dividend growth model to Woolworths. Just for a real life example, the assumptions were a long-term sustainable growth rate of 8%, which was approximately 5% inflation and 3% real growth, cost of equity of 14%, risk-free rate of 9% as the base, and then they added a risk premium of 5%, saying, you know, based on the risk of this particular share, that's what we think that 14% is a good cost of equity. They're assuming high growth in earnings and dividends for the next 5 years, and then it's going to fall to 8% per year. The latest dividend paid is $2.39, which is D0. Expected growth rate for 2019 is 15%. That's D1. We're doing this in 2018, by the way. So 2019 would be D1. Or time period 1, put it this way. And the expected growth rate is 15%, and then it's 11% per year after that until 2023. So D2019 will be D0, which is 239, times 1 plus 15%, which is R2.75 odd. The next one is going to be 11% higher than 2019's dividend. So we grow it by 11%. And the next 3 after that, all growing at 11% as per the specification. This is obviously Woolworths' dividend policy at the time. After 2023, they're going to have a constant growth rate in their dividends of 8% per year. They're going to settle down to 8%. So we need D20 2024 to work out the price as at 2023. D2024 will be 8% higher than D2023. So we take D2023 and increase it by 8%. That gives us D2024. So in a way, we're saying PT is equal to DT plus 1. Remember our old formula for our constant growth phase. The first dividend that's going to incorporate the constant growth rate of 8% is the 2024 dividend. So that's T plus 1. So T must be 2023. So we're valuing this constant growth phase of dividends as at 2023, which is the present value of every dividend from 2024's dividend onwards. And that is 75 Rand 103. So we use our financial calculators to work out the values as of today being 2018 in this example. So naught is our CF naught. We've got D1, D2, D3, D4, which we put them in as our CF1, CF2, CF3, and CF4. For CF5, we've got to add 2023's dividend, don't forget it, and add P 2023, which takes care of 2024's dividend and onwards. Add those two and we get 79,2754 as our CF5. 14 is our IYR because they told us to assume a cost of equity of 14%. And a Woolies share as of 2018, its intrinsic value was 50 Rand 44. Now, in actual fact, its share price on the 21st of September of 2018 was 51 Rand. So pretty close. That was a real life example of using the dividend growth model based on Woolies' projections and sustainable growth rate projections, cost of equity assumption, what they thought their growth was going to be in the next few years, and then what it was going to be after that. And it was virtually spot on. The intrinsic value turned out to be very close to what Woolies shares were trading at in the market at that particular time. Okay. Sorry, that was the comparison of to the listed price. Now, whilst the dividend discount model and the free cash flow model that's still to come are both based on discounting future cash flows, investors also use price multiples, such as PE multiples, market to book ratio multiples, to determine whether shares are over or undervalued. The PE ratio measures the relationship between the firm's market price and its earnings per share. So it's market price per share divided by its earnings per share. That's what a PE ratio is. Now, if a firm has a high PE ratio, does it mean that the company shares are overvalued and then the converse? Well, there's been a lot of research into this, and this particular researcher indicated that high PE ratios generally do indicate overvalued shares. But basically, we've got to use PE ratios of comparable companies to the one we're trying to value its shares, or we could use sector averages. Unfortunately, these are things that are quite available to the market. If we're trying to value an unlisted company, in other words, doesn't have a listing on the stock exchange, so we can't see its it's not traded, so we can't see those market prices. We can use a listed company, a comparable listed company in the same industry as the unlisted one to value it. And we do that by multiplying a forward earnings per share of the company by a comparable company's forward PE ratio. Okay, so if the PE ratio PE is equal to market price per share over earnings per share. So we're going to predict what the earnings per share is going to be for this particular firm we're trying to value its equity. We're using a comparable PE ratio. And if we've got those two variables, we can solve for a suitable market price for that particular share. A couple of pitfalls of using PE ratios. They're based by and large on historical earnings, and they're also based on accounting earnings and not cash flow. We can get around this first issue of being based on historical earnings by using a forward PE estimate, so a projected PE ratio based on the estimated earnings of the firm for the next year. But despite these two disadvantages, it's a useful and very quick and easy indicator of value. It's very easy to apply. So let's look at an example. Remember, some shares pay no dividends, and so using PE ratios might be a good way to evaluate such a share. We can't use our dividend discount model. So we're going to value a share at time period 0 by taking an estimated or projected earnings per share for the next period. So if this is PN, if N is today, then the next time period's expected earnings per share, and we'll multiply that by an industry average PE ratio. We'll also try and get, that must also be a projected one. For example, if Chloe's expected earnings per share is R2.60 a share, and the industry average, let's say it's also an expected industry average over the same time period, PE multiple is 7, then we just multiply the earnings per share by 7 and we value the share. Okay, it's pretty simple. So it's pretty useful when shares aren't paying a dividend, they don't pay a dividend. Typically then those that are not publicly traded, in other words, they're not traded or listed on the JSE, they might be privately owned companies or whatever the case may be. That's where this method comes in handy. We can also use earnings before interest and tax, or earnings before interest, tax, depreciation, and amortization multiples to value a firm. This is to value the whole enterprise, okay, not just the equity or shares. So we use the PE ratio to value ordinary equity, but we're going to use one of these multiples to determine the value of the whole firm or the enterprise, okay? And then we're going to deduct the value of debt to get the value of equity at the end. So by using earnings before interest, taxes, depreciation, amortization, we can ignore differences in depreciation policies between firms. And we can also ignore different financial leverage of different firms. So some might have no debt, some might have a lot more debt than others. And when you're using comparable figures, you don't want those types of differences to skew your results. So if we use earnings before interest, taxes, depreciation, and amortization, Interest hasn't come off yet. So, you know, we don't have to worry about differences in financial leverage, nor depreciation. So different depreciation policies won't skew the results either. So quite simply, if a firm has an EBITDA of 240 million and comparable firms are trading on an average EBITDA multiple of 7.5 times, then the firm value will be, take its earnings before interest, tax, depreciation, and amortization, and multiply it by a comparable firm EBITDA multiple. Okay. In other words, the average sort of comparable firm's value is equal to their earnings before interest, tax, depreciation, and amortization times 7.5. Okay, so we're applying that same multiple of 7.5 to this firm EBITDA figure, and we're valuing it at 1.8 billion. And then you deduct the value of debt to get the value of equity. Okay. Along the same vein as PE multiples, we can use the market to book ratio. So your book value per share is your shareholders' equity divided by the number of shares. And your market to book ratio is your share price, current market share price, divided by that book value per share. Now, you know, PE and market to book ratios are things that are going to come up in topic 3. But that's why I'm just giving you the formulae here. But basically, if we're looking at this, and this is also a method that's used to value ordinary shares or share capital, just like your PE ratio. So if our total shareholders' equity, we've got a whole lot of different retail outlets here. This is their shareholders' equity. This is the number of shares they have in issue. That, therefore, is their book value per share, which is their shareholders' equity divided by the number of shares. This was their market price per share on this particular date. Therefore, their market to book ratio, market to book, so it's the 16.46 over the 15.46. So it's the market price per share line over the book value per share. These are the market to book ratios for these firms. Now, high growth companies will tend to have high market to book ratios. And they're also very dependent upon the particular industry sector. But how are you going to value a firm's share or equity is you're going to multiply its book value per share by a similar company's market to book ratio. So if this particular firm we're trying to value its shares has a book value per share of 180, and similar companies are trading at a market to book ratio of 2.5, then you just multiply the two to get an estimate of share value, 450. Okay, so again, it's used like the PE ratio as a multiple to multiply by, in this case, the book value per share to get a share value. Okay, I hope you are, now I've got a dog fight in my hands. I hope you are taking regular breaks because this is a pretty long session. But we're moving now on to the free cash flow model. Conceptually very similar to the dividend discount model, where we had variable dividends. You remember the assumption number 3. So here, instead of valuing dividends, we're valuing the firm's free cash flows. And instead of valuing shares, we're valuing the entire firm. Okay. So the value of the firm is the present value of the future operating cash flows discounted at the firm's weighted average cost of capital, WACC. You're going to come across that a lot in finance and beyond. So the firm's cost of capital is the weighted average cost of capital. It's a weighted average of their costs of equity, cost of ordinary equity, cost of preference share equity, and cost of debt. But a lot more about that later on in Finance 202. So we have to value the cash flows during the initial period. And then once the cash flows sort of settle down, we have to work out a present value of the terminal value as well. I'll show you what we mean just now. So at the end of the explicit period, we'll have to value at the terminal value. And we'll add the present value of each of those to give the value of the firm. And then once we have the value of the firm, we'll minus the value of debt to get the value of ordinary equity. Okay. What is free cash flow? So these cash flows I'm talking about, it's your net operating profit after tax. Okay. So that's an accounting figure. Add back depreciation because that's a non-cash expense. And we're trying to get cash flows, free cash flows. We're making an adjustment for any capital expenditure. And we're also making an adjustment for any increases in net working capital. Okay. So this part of it is sort of taking care of your operating cash flows. And then we're also making an adjustment for anything that's spent on CapEx or net working capital as well. You can use, as an alternative, get straight to the free cash flow to equity, okay, instead of having to get the value of the whole firm and minusing the value of debt to get the value of equity. You can use your free cash flow to equity model. And here you discount the cash flows due to shareholders after financing costs and changes in financing flows. So it's slightly different. Your free cash flow to equity is also your NOPAT plus depreciation minus CapEx and minus any increases in net working capital. But we're also minusing any financing costs plus or minusing any increase or decrease in debt financing. So we're completely taking out the cash flows pertaining to debt financing so that we're just looking at the free cash flows pertaining to equity. And instead of using the firm's overall weighted average cost of capital, we'll use the cost of equity as the discount rate. Now, I'm not going to dwell too much on this alternative. It is used for valuing firms with very high levels of debt, and it's also commonly used for valuing banks. But for most other firms, we're going to use the free cash flow to operations to value the firm, and then we'll deduct debt. So this model here. Okay. So just to reflect on the adjustments that we're making to our net operating profit after tax. As I said, we're adding back depreciation and any other non-cash charges as well. For example, if you're amortizing intangible assets. These don't represent physical outflows of cash. They're just book entries. So we've got to add that back. We've got to add them back, get closer to cash flow. We also have to include any changes in net working capital for the year. An increase in net working capital will be a use of funds, and it'll be minused. A decrease in net working capital, which is highly unlikely, would be a source of funds, which would be added. But this is things like I hope you all know that working capital, or net working capital, is your current assets minus your current liabilities. So if the firm's going to be taking on more inventory, needing more cash reserves, resulting in more debt, increasing sales, which is going to result in more debtors, because they're increasing inventory is going to result in more trade creditors, etc. There's going to be a change in their net working capital requirements, and we have to reflect that as well, because those aren't reflected in your net operating profit after tax. And similarly with capital expenditure, so your operating income or earnings aren't reflecting what's going on with your capital assets. You know, you might have to buy some new ones or replace existing ones. And you can calculate the capital expenditure from your balance sheet and your income statement. You'll look at the increase in net property, plant, and equipment. You'll add depreciation for the end of 1 year and minus it from the beginning of the year. And then you'll get what was either spent on CapEx or redeemed. If you had a net sale of your fixed assets, it would be a minus. It would be a plus. But most of the time it's going to be a minus any additional expenditure on capital expenditure. Don't worry too much about these finer details using this method. I'm not going to expect you to actually start with net profit after tax, or even start with sales and go through an entire income statement and then add back your depreciation and minus your change in net working capital and minus any CapEx to get to your free cash flows. Usually I'll give you those free cash flows to start off with, because this is what you're going to be doing later on in the second semester of finance. So I'm not going to worry you about it now. I just wanted to show you what goes into a free cash flow calculation. Okay, so we spoke about a terminal value, which is after your explicit period ends, and it's called your continuing value. So we'll usually estimate the future cash flows for a certain period, and most firms don't really want to go much further than 7 to 10 years as a planning horizon. And then determine a continuing value after that initial period, assuming a constant sustainable growth rate and margin. So the same cash flows or growing at a certain rate, constant growth rate after that. So it's exactly like, as I said before, when you're using the dividend growth model to value variable shares where you've got variable dividends. You know, initially you've got different growth rates, and then you resume a phase of constant growth rate and dividends. Same here. Initially we'll have forecasts of future cash flows for a certain time horizon. And then after that, the assumption will just be that the last cash flow will just increase and at a steady rate to infinity. Okay. So this was the alternative method that I showed if you're just going to be trying to solve for the value of the firm's equity, where you know, in different method of using your free cash flows, K is your cost of equity that you use. This is the one we're focusing on, where you value a firm and that sort of terminal value you'll get by taking the first free cash flow after that explicit period and dividing by the weighted average cost of capital minus G. So let's put it into practice, and you'll see it's very similar to what you've done before with shares. Here's some information. We've got the free cash flows for this firm for 1, 2, 3, 4, 5 years. Other data is that beyond 2019, which is this 5th year here, those free cash flows are going to grow at 3% to infinity. The weighted average cost of capital is 9%. The market value of their debt is 3.1 million. The market value of their preference shares is 800,000. And the number of ordinary shares that they have in issue is 300,000. So we want to value a share using this free cash flow model. Okay, step 1. just like before, when we had 3 steps to value ordinary shares, whether dividends were variable or non-constant growth scenario. Firstly, we're going to calculate the present value of the free cash flow occurring from the end of 2020 to infinity. And we're measuring that as at the end of 2019. Okay. So the value of the free cash flows from 2020 onwards, which is a value as at 2019, in fact. Sorry. We take the 2020 free cash flow and we divide it by WACC minus G. So the 2020 cash flow, you'll see, was the 2019 cash flow was 600,000. So that's 2019, 600,000. We're going to grow that by the constant growth rate of 3% to get to the free cash flow for 2020. And we divide that by WACC of 9% minus the constant growth rate. So the value of the free cash flows start with 2020, but we're valuing it as at 2019 is 10.3 million. Okay. Next, I'm going to add the present value of the free cash flows from 2020 to infinity to the free cash flows for 2019 to get total free cash flow for 2019. So 600,000 was the free cash flow for 2019. 10.3 million was the present value of the free cash flows from 2020 onwards. So free cash flow as at 2019, is 10.9 million. And the final step in this instance, when we're using the free cash flow model, is to find the sum of the present values of the free cash flows for 2015 through 2019 to determine the fee firm value. Then we're going to subtract the market values of debt, the market value of preference shares to arrive at the value of equity. Okay, so the cash flows are, and these were given, 400, 455, 25, 60. 2019, now we've added the 600,000 free cash flow to the present value of the free cash flows from 2020 onwards to get 10.9. We feed everything into our calculator. We get an NPV of 8.628,234.11 million. And that's as at year naught, which would be 2014. First cash flow was happening a year later, 2015. Now all that remains is that's the value of the firm. We're going to minus the value of debt, market value of debt. We're going to minus the market value of preference shares to get the value of equity, and we'll divide that by the number of shares to get a value per share. Okay. So a step-by-step, in this case, 4-step process for free cash flows, just like we had a 3-step process for shares when the dividends are variable. Just follow that and you will be able to value a firm's shares using the free cash flow model. So step 1, you handle that terminal value. You add that terminal value to the free cash flow for the time period before the terminal cash flows start. You value the firm by present valuing all the free cash flows, including the terminal value. And then you minus the value of the firm's debt and its preference share capital to get the value of ordinary equity. And finally, you divide by the number of shares. Okay. Right in my face here. Okay, we're going to look at the EVA approach, economic value added. Again, it's not at this point something that I need you to worry too much about. Just know that it is an approach. As I said, I want you to focus on the free cash flow method to value a firm and then get to the value of a firm's shares, as well as using your dividend discount model and your multiples as well, your PE multiples in those. So less important is EVA at this stage. So EVA is your net operating profit after tax minus your WACC times your asset book value. Okay. So your asset book value will be your invested capital. And then your value of the firm will be the book value plus the present value of your future EVAs. Okay, and there's an example here. This company is earning a return of 25% for the next 3 years, and its WACC is 10%. The book value of its assets is expected to remain at 180 million, and the return after year 3 will be 10%. It's got debt of 60 million. So again, we use EVA to value the whole firm. Then we make an adjustment for the value of debt, and if there's any preference share capital, to get the value of equity. So that's the closing asset book values, 180 as given. These are the NOPAT figures, which are, in this example, 25% of their capital invested, their asset book value, minus the capital charge, which is WACC times the opening asset book value for each year, which stays the same at 180. And that gives you your EVA figures. Don't worry about the PV factors in the PV and getting to the 65.715 in that way. You're going to use your financial calculators. So you'll put cash flow naught will be naught. Cash flow 1 will be the first year's EVA. Cash flow 2 will be the second year's EVA. Cash flow 3 will be the third year's EVA. Why we don't go beyond that is because in this particular example, the return after year 3 will be 10%, which is the same as their WACC. So because the return on capital is equal to the weighted average cost of capital, then we won't worry about cash flows, EVAs after that. They'll all be zero. Okay, and then it's just a case of present valuing each of these 3 amounts. Adding your book value, giving you your value of the firm, minusing the value of the debt, giving you your value of equity. So yeah, as far as I'm concerned, just know that there is another approach called the EVA approach. Know the brass bones of it, but don't expect a practical example of EVA just yet. It's a bit premature in the module. Okay, and this is a unique example because there was no terminal value because the return on capital was the same as the WACC. So it was a tricky example anyway that your book gives. Something we need to remember is the impact of share options on equity valuation. So they need to be included or borne in mind when you're valuing an ordinary share, because if there is a share option on the table, remember, it offers the holder the right to buy the share in the future at a fixed price. And if options are likely to be exercised, just say the current share price is 10 Rand and the exercise price is 2.50 Rand, then what you must do is increase the value of total equity by the exercise price revenue. So if they're going to issue 10 million options or make available 10 million options, which if taken up at the exercise price of 2.50, you must increase the value of total equity by that product. So 10 million times £2.50. Similarly, you must increase the number of shares by 10 million because an additional 10 million shares will have been issued via this share option. And so you must take those into consideration as well. Here's this example. So if you value the firm at 600 and you minus the debt and you've got 480, but there are options on the table. This is the no option scenario. The value of equity will be 480 divided by the number of shares, gives you the value per share. If there are options, 25 million revenue is going to be coming in. So you need to add that to the value of equity. And another 10 million shares are going to be issued. So when you're dividing by the number of shares, you must divide by 50, not 40. So it does make a difference. And it's just something to be borne in mind. So let's come back to our most important person, who's our financial manager, whose main purpose, as you will have learned in topic 1, is he or she needs to focus on value maximization. And that's why the intrinsic value of a company is so important to a financial manager. That's exactly what he's focusing on, is value maximization. Specific instances where valuation is important, when a company is wanting to list, then it's obviously going to need to be valued, not only the holding company, but also all its different divisions. If a firm is looking to acquire another firm or divest of part of its own firm, the correct exchange ratio needs to be established. For example, if they're going to, through a merger, they're going to be paid in terms of equity, then the equity of both firms need to be valued so that a suitable exchange of equity in the two firms can be arrived at. When a firm's trying to determine an optimal capital structure, and you're going to learn a lot more about that in finance too, valuations are also important. They're important for determining cost of equity and WACC. They're important when a company wants to maybe buy back some of its shares that it's issued. And they're important because managerial compensation, what they get paid, the bonuses, etc., might be based on the value of the company's equity. So valuations are often used in negotiations of two parties who might have completely different objectives, and they might come up with different valuations. And there's got to be a bit of give and take in the negotiating process to arrive at a value that both parties can agree to. And just remember, the valuation of any company is very subjective, or it can be very subjective. It's based upon assumptions about the future, and different analysts are going to have different views. And when we're making investment decisions, although different valuation methods might produce different values, hopefully they're all going to be in more or less the correct ballpark, so that any decision that gets made is more or less the right one. It might not be, it's not an exact science, but as long as if it's in the right ballpark. And sometimes that's why using multiple methods is a good idea, because then you can see, okay, let's just take an average between all of them, or lean more towards one method than another because you're more confident about the assumptions and the predictions that you made. So it's not an exact science, but if you apply some of the theory that we've been, or the approaches that I've taught you today correctly, you should end up in the correct ball, in more or less the right ballpark to arrive at the intrinsic value of a share or a firm. Okay. Some pitfalls, just to remember. Don't confuse the valuation of equity with the valuation of the whole firm, which includes both equity and debt, remember. In the same vein, don't use the wrong discount rate. If you're working with cash flows to ordinary equity, you use the cost of equity. If you're using cash flows to the entire firm, you use their weighted average cost of capital. Don't double count for risk in both your cash flows and your discount rate. In other words, don't apply if risk is high and you want the required return, therefore, to be higher, don't adjust it and your cash flows for that higher risk. And I'll be teaching you how to adjust for risk in the capital budgeting process in the third year. Remember to recognize the risk of a changing capital structure and the discount rate. Sometimes there are no comparable firms. If you're using one of those PE or market to book or EBITDA multiples, sometimes you're just not going to find them for a comparable firm. And those are useful to use as benchmarks. Don't double count for synergy. By increasing your cash flows and reducing the discount rate. This is if you were looking at a merger or acquisition of another firm. Don't increase the discount rate for country risk when this is already included in the risk-free rate. Again, that's for another time. And don't underestimate the value of control. So, there's a little spiel about that in your textbook. You can read through it, but that's also, I'm not going to go into too much detail about that, and not as much detail as your book does anyway. And a South African CA called Greg Beach was quoted in your textbook as saying that you should make peace with the fact that your valuation is likely to be incorrect due to being unable to predict future cash flows, future dividends, etc., with any with 100% accuracy. So you rather go for minimizing any errors in the whole process and know and apply the theory correctly to the circumstances at hand. So I think that's the best advice to take away from this is you're not going to be 100% accurate. As I said before, if you follow the theory and the processes correctly, you should end up in the right ballpark. It's not an exact science. So I think that was a good note to end off the valuation section on. And that's really the end of topic 2. So make sure that you understand the concepts, make sure that you attempt the relevant tutorial, and we will be having a revision session soon on topic 2, as per your teaching calendar. Thanks for joining me, and take care of yourselves. Bye now.